It's going to be a rumbly-tumbly 2010, and here to explain why he thinks so is Pat Morris of Hagen Investment Management. Pat, thanks for joining us. Rumbly-tumbly, that's the words you used moments ago. Why? Why so?
Well, I think we're still waiting to see what's going to happen with the U.S. consumer. Right now, we've sort of gone through the down part of the cycle. People were hoping for a V-shaped recovery. It looks more like a U-shaped recovery, though we've yet to see that other leg. So we're, in my opinion, still in an L. Unemployment's very high. Consumers are basically not using credit as much as they used to.
And they're actually paying back credit, right? That seems to be what's happening. They seem to be the quote-unquote deleveraging.
Well, and they get in trouble for that, too. It's funny, on the way down, we were told we were over-leveraged, and now that we're deleveraging, we're being told that that's bad, too. But that is what the consumer is doing, so that should put pressure on the U.S. economy.
Okay, and the world economy, too.
One would think so. Emerging markets have sort of delinked from the U.S. economic picture, but I don't see that that can sustain itself because the U.S. is the big consumer of a lot of their finished goods. Okay,
now what are the investment implications of this? Because it's all very nice to look at things in theory, but how can we make some money, or how can we not lose money in the event of it being as horrible as you say?
Well, we've seen some news this morning about one of the Fed presidents saying that he thinks that the Fed is going to have to get aggressive with interest rates somewhere in the near future.
Okay.
So that implies to me that if you own...
And that will be because of inflation worries, right?
Well, you have to stop the stimulus at some point, or you create the possibility of hyperinflation. In the current situation, it would be what they call stagflation, where we're not growing, but we're paying up for things. We don't want that. So what they might have to do is raise rates in early 2010. So that says to me, you want to be very careful with your U.S. Treasury bills, any U.S. Treasury-linked asset, because those bonds will underperform if rates rise.
And what tends to happen there is as interest rates go up, the value of the bond goes down, and so if you hold bonds, you lose money. So avoid those in favor of cash, or what?
Well, I think cash is never a bad asset to have, but I do think that you have to look toward equities, maybe what they call defensive equities. So those are things like materials companies, basic material companies, things that you use every day, staples. You want to look toward...
Like P&G, Kraft,
I think those are great names. I think some of the larger healthcare names are also a good idea, the Pfizers of the world. There is some risk there, but it doesn't look like this
healthcare. And that's healthcare legislation risk that could hurt.
That looks like it's going to be pretty slow, though, so I wouldn't worry about that right now.
And how do you feel about a small measure of gold in a portfolio? Is that a good idea or not?
I think gold's a great idea, but always remember that the value of gold is that it is gold. It's not really used for anything else. So it has sort of an intangible value, so to speak. If you're really worried about things to come, though, gold's never a bad thing to hold.
Again, how much would you say for an average portfolio? How much percentage-wise?
I would think more than 5 or 10%, and you're probably doing yourself a disservice. I think there's better places to put your money.
Stick to 5 to 10%. Thank you very much. That's Pat Morris of Hagen Investment Management. I'm Simon Constable, and this is the Wall Street Journal Digital Network.